Namaste, good morning. Uh, Wishing you all Mahashivaratri, and I pray Shivan to give you a very successful result uh, and a successful journey of life. Well, the classes are the classes which I have planned for. This is an exclusively amendment classes. Um, Pre-instructions include only amendments are covered, followed by this classes during mid March or end March, mostly end March, because again many of you texted saying that give us that preparation time, so that by end March if you conduct the revision we will be better. So by end March there will be a revision session also, which will be useful to you. Yes, revisions are an what I would say an extension. Revisions are an extension of amendment classes. So I would definitely request all students who want revision classes to attend or to watch amendment classes also. And the next instruction which I have already provided, that I am not going to give you the amendment material directly. Okay, I'm not going to give you this amendment material directly. I'm going to make you write in the classroom. That will help you. I believe amendments are going to be for 20 marks, be it the whichever examination you are going to write. I believe that amendments are going to be 20 marks. So if you want to score that 20 marks, which is very vital for us, I would definitely request you to write the amendments once, not just give the reading of the amendments. So writing the amendment once will be helpful for you. So please understand that I am not going to give you the amendment material at the beginning. I will release it after the classes are getting over. Which class you want to be? Upstairs. Okay, so this is on the material part of it, and then on the uh, timing part of it, I have already told you. Yes, I will consider 6 to 10. On a safer side, I have taken 5 days. I think we will be completing it in 4 days. Today being a day where I am focusing on one big amendment, that is on slum sales. The others are going to be smaller amendments which I am going to focus on salaries, capital gains. Tomorrow will be the two major amendments which will be mind-blowing amendments in my opinion. One is the 9B and partnership 45.4, and then the trust related amendments. The day 3 will be all the remaining amendments. Day 3 will be day 3 will be all the remaining amendments on the income TDS TCS front, plus the administrative amendment. Day 4 will be actually international taxation, very less amendment. There are amendments, something like business connection, something like non-resident taxation, rates of taxation. Those are all the small amendments which we will see in the last day of the classes. But I am keeping still the classes open for a 5-day period, but I will definitely try to save time for you, right? The material which I have posted in the group as of today is only having questions. And I mean it, that first level, you have to write the amendments so that you will be able to appreciate it. Without wasting much time, let us go into one by one the amendments, and then understand every amendment little detailed, along with answering practical questions. In the rates of taxation, in the rates of taxation, there is no amendment except in the case of companies. In the case of companies, the turnover of 400 crores for the financial year 1920. So this will keep changing normally. So companies are taxable at 30%, but but in the financial year 1920, if your turnover or gross receipts, depending upon your method of accounting, depending upon your nature of company, okay, nature of business, okay, so that's why I have okay, so it is the turnover of 400 crores for the financial year 1920, okay, that means the only amendment with regard to rates of taxation, with regard to rates of taxation, okay, otherwise rates of taxation surcharge have remained the same. For doing questions on rates of taxation and surcharge, we will do it in revision sessions completely once more, and at that time I will touch upon this. In your notebook, amendments in the chapter of salaries. In your notebook, amendments in the chapter of salaries. It is all boiling down to section 17, that is the perquisite related amendments. It is all boiling down to perquisite related amendments, especially interest credited by Provident Fund on employees' contribution. Interest credited by Provident Fund on employees' contribution. Interest credited by Provident Fund on employees' contribution. Primarily, I will tell you something, that employees' contribution is taxable. We all know employees' contribution is taxable. How do I say employees' contribution is taxable? If you people understand that if the basic salary of the employee is 1 lakh and 10% is deducted as Provident Fund and the employee is paid only 90,000, 90,000 is not taxable. The entire 1 lakh is considered as gross salary. Okay, so primarily please understand employees' contribution to Provident Fund. Can we start from there? Okay, point number 1, employees' contribution to Provident Fund. Employees' contribution to Provident Fund, okay, be it SPF or RPF, whatever may be it, or even URPF, everything, okay, is taxable as gross salary, is taxable as gross salary, full stop, continue. However, deduction under section 80C will be provided. However, deduction under section 80C will be provided. Deduction under section 80C will be provided. So we all know this, there is no change in that. Now, where does the change come from? Okay, it comes from the interest. Okay, normally till last year, up to 9.5% fully exempt. Over and above 9.5%, interest becomes taxable in the hands of the employee if it is RPF. SPF, obviously, they don't give more than 9.5%. Okay, so that was the provision. Now the amended law says the whole of the interest for the contribution in excess of 2,50,000 becomes taxable. The whole of the interest, that, okay, it is the employee's contribution in excess of 2,50,000 interest on Employees contribution. Remember, this is not contribution which is taxable. Contribution is already taxable, because the next provision I am going to tell you, even though it's not the amendment of this year, but I want to relate and show you, because there I am going to speak about contribution. Here I am only speaking about interest on employees contribution. So the next point, okay, till financial year 2021, till financial year 2021, till financial year 2021, interest in excess of 9.5%, interest in excess of 9.5% will be taxable in the hands of the assessee or employee, whatever you want to write, will be taxable in the hands of the employee, or you can write it as assessee, will be taxable in the hands of the employee or assessee. Okay, next line is the amendment which we are speaking. From financial year 21-22, from the financial year 21-22, this is the amendment. Interest on the contribution in excess of 2,50,000. Interest on the contribution in excess of 2,50,000. I am only talking about employees' contribution. I am only talking about employees' contribution. Interest in excess of contribution of 2,50,000 becomes taxable. Becomes taxable. Interest in excess of rupees 2,50,000. Okay, become okay on the contribution in excess of 2,50,000. Now there is one more thing which you need to understand. This threshold of 2,50,000 is provided both the employee and the employer contributes. Where employer does not contribute, only employee contributes, then the threshold will be 5 lakhs and not 2,50,000. The threshold will be 5 lakhs and not 2,50,000, where there is no employer contribution. You can easily understand this more about PPF. PPF is one where we don't have the contribution of employer. PPF is more for people, self-employed professionals. Okay, so next line. Next line, where employer contribution, where employer contribution does not arise, then the threshold shall be 5 lakh instead of 2,50,000. Then the threshold shall be, that is, interest in excess of 5 lakh contribution will become taxable. Then the threshold will be 5 lakhs instead of 2,50,000. Then the threshold will be 5 lakhs instead of 2,50,000. And my dear friends, please remember, this is a prospective amendment and not a retrospective amendment. Whatever is the accrued balance up to 31st March 2021, whatever is the closing balance on that, whatever is the quantum of interest, that is not going to be taxable. So actually the CBDT circular itself says what is not taxable component, what is taxable component. Okay, up to 31/3/21, whatever is the contribution, that will not become taxable. Whatever is the contribution, it will not become taxable. Okay, interest on that will not become taxable. Interest up to 2 lakh, I mean, contribution up to 2,50,000. Any contribution up to threshold limit being 2,50,000. Okay, any contribution up to 2,50,000 not taxable, or 5 lakhs in the case, and interest on them. These will not be taxable. And if there is any withdrawal that needs to be reduced, we all know in the case of daughter's wedding and house building, the PF withdrawal is possible, and whatever you withdraw has to be reduced. So what is the taxable component? In excess of threshold, whatever is the interest. In excess of threshold, okay, yearly threshold of 250 or 5 lakh, 250 where employer also contributes, 5 lakhs where employee alone contributes or assessee alone contributes, on that it becomes taxable. This is the first major amendment in terms of salaries. This is the first major amendment in terms of salaries. Okay, right? Let me go to question number one. Let me go to question number one. Sriram is employed in Ayodhya Limited for a basic salary of 2 lakh per month and DA forming part 1 lakh per month. He, as well as his employer, contributes 15% of salary towards RPF. For the financial year, the fund credits interest 2,75,000. On analysis, you identify that 2 lakh interest is for the opening balance of the fund and balance 75,000 is for the current year. Compute his taxable salary by applying the various provisions of the law. Read through. Okay, I have posted the material also in the group. Okay, if at all, but this will be better for you. Friends, the material is also there in the group for you. That is only, I mean, the question related material. I am not giving you the final material till the classes gets over. Just give me a minute. Start working. Okay, when we do some questions, I try to recollect some other provisions also, so that apart from amendment, wherever there is a related provision, I try to recollect them just to, okay. But now focusing on this basic salary. Basic salary, the question says 2 lakhs per month. Okay, 24 lakh. DA forming part 1 lakh per month. So this comes to 36 lakhs. Employees contribution to PF, employee's contribution, he as well as his employer, okay, contribute 15% towards RPF. He as well as his employer, which means both of them contribute 15%. Okay, employer's contribution 15% of salary, which comes to 5,40,000. My dear friends, one thing I want you to understand, this is always part of this 24 lakhs or 36 lakhs. Okay, please don't tax that 5,40,000 is already included. When they pay you, they will not pay you 24 lakhs or they will not pay you 36 lakhs. They will pay only 30 lakh 60,000. For example, only if these two are only there, they will pay you 30 lakh 60,000. So please don't get confused on this 5,40,000 treatment. We are not even talking about this 5,40,000. This is already part of salary. This will be eligible for 8PC, that we all know, leaving that part. So 5,40,000. So this is in excess of 2,50,000 because the employer also contributes, though the threshold limit, okay, for interest computation is arriving. Now coming back, interest credited by PF department for the year, it comes to 2,75,000. The question says that the interest credited by the fund is 2,75,000 less interest on the accumulated balance till 31st March 21. That is 2 lakhs. Remember, this is never taxable. This is exempt. This I am not at all taxing it. Okay. Therefore, interest for the financial year 21-22 is 2,75,000 minus 2 lakh, that is 75,000. Interest for the financial year 21-22 is 75,000. Okay, interest for the financial year 21-22 is 75,000. Now coming for the amendment related aspect, taxable interest. Taxable interest for the contribution in excess of rupees 2,50,000. For the contribution in excess of 2,50,000, 75,000 divided by 5,40,000 into the contribution in excess of 250 is 2,90,000. Is 2,90,000. The contribution, total contribution is 5,40,000. Contribution in excess of 2,50,000 is 2,90,000. So it will be 75,000 into 5,40,000 into divided by 5,40,000 into 2,90,000. So this 40,278, 40,278 will become taxable. This 40,278 will become taxable. This 40,278 will become taxable. Okay. Okay, so please understand, up to 2,50,000, for the contribution, the interest is exempt. Beyond that, it is. Is this the computation? As of now, this is the computation, because I will tell you as the class goes by, the computation might change if the department, if the CBDT gives a circular as to how the computation has to be. As of now, this is the computation. May not be correct, because I will also know that if the contribution is from the month of March, April to March, so the interest will progressively keep changing. So may not be correct, but as of now, if a question appears, this is the best manner of computation. The CBDT has not given any circular on that contribution computation, but whereas I will tell you very soon, in employers' contribution, they have given how to compute. For employees' contribution, they are yet to give. So as of now, we stick on to this basis of computation. Okay, a quick wind up on, as I told you, when we do some questions both in amendments, and we try to recollect some things also, we take. Okay, so a quick amendment on how to compare. Actually, I also have a parallel opinion. I know this is not the sessions for opinions, etc., but just to give you a brief, that I think this should be taxable under IFOS and not salaries. I think it should be taxable under IFOS, but amendment has appeared in salary chapter only. Okay, so I will take it up in salary, but normally employer relationship, here the interest is paid by the PF department to the assessee, so it should be taxable under IFOS. But as of now, our institute, there is no question in our institute material. This is just so they have just given the CBDT circular and left it. So I just framed this question now. Computation of taxable salary. The question has asked us to do the salary. Okay, here the first thing which I am trying to recollect you is excess contribution by employer. The employer can only contribute up to 12% of salary. Employer can contribute only up to 12%, or can allowed to contribute up to 12%. Over and above 12%, it becomes taxable. Excess contribution by employer to RPF. Okay, 36 lakhs into 3%. Why 3%? In excess of 12%. In excess of 12%, it becomes taxable. So that part of it is the first thing to understand. 1,08,000 employers' contribution becomes taxable. 1,08,000 employers' contribution becomes taxable. Excess interest credited on employees' contribution. Okay, I should not write excess interest. Sorry. Interest credited on employees' contribution in excess of rupees 2,50,000 is what we have worked out. 40,278. 40,278. This leads me to gross salary. taxable salary 3698 to 78. Okay, note, note. Employees' contribution is eligible for 80C. Okay. The first amendment and its related question. Okay, right, right. The second is not the amendment of the current year, but at the fag end of last year, there were circulars released on this behalf. So I'm covering that also as part of your amendment. Okay, the heading is employer's contribution to, the heading is in your notebook, the heading is employer's contribution to, employer's contribution to, under that A, Provident Fund, B, Superannuation Fund, Superannuation Fund, C, Pension Fund, C, Pension Fund, employer's contribution to Provident Fund, Superannuation Fund, and Pension Fund. Okay, the amendment of the last year, okay, is the total contribution, the total under that, the total contribution on all these funds shall not exceed 7,50,000. Shall not exceed 7,50,000. Full stop, continue. If it exceeds, if it exceeds, such excess is taxable in the hands of employee. Such excess is taxable in the hands of employee. Okay, such excess is taxable in the hands of employee. The employer's contribution is restricted to 750. Then came, this was an amendment in the Finance Act itself of the Finance Act 2020. Then the CBDT came up with this circular almost at the fag end of the last year on how to compute the annual accretion on the balances and what amount becomes taxable. Okay, there is a formula which the CBDT has given for this. As I told you, writing this formula once will help us understand how it is being computed. Okay, so this is for the interest in for the contribution in excess of 7,50,000. This is only for the interest in contribution in excess of 7,50,000. Okay, taxable. So the next one we are heading we are writing is, okay, interest on contribution in excess of 7,50,000. Interest on contribution in excess of rupees 7,50,000. Interest on contribution in excess of rupees 7,50,000 hyphen rule 3b hyphen rule 3b. Okay. TP is equal to, it's there on the screen, but I want you to write for sure. TP is equal to, open bracket, PC by 2. What is by 2? Average balance. Because as I told you right now, okay, for employees contribution, I cannot say that the formula is fully correct because it depends upon April, May, June, July, how the contribution varies. So this is average balance. That's how we do it in mathematics. Whenever there is a constant contribution, we take the average and compute. So that's why PC by 2 close bracket into R, which is going to be the rate of interest, plus on the accumulated balance they are coming now, PC1 plus TP1, PC1 plus TP1 close bracket into R. Okay. Before going into the explanation, I will make it once more clear to you the formula in technical terminologies. After that, we can go into to understand or by heart the formula. TP is taxable perquisite. I am going to tax it. I am going to take the average of the balance which has been contributed. That's why PC by 2 into rate of interest plus not only average of the current year, last year's also, I would have made contribution in excess of 7,50,000. Last year also, I would have made a contribution in excess of 7,50,000. That last year, what was the perquisite? Last year, the interest accumulated. TP means we all know, okay, what it is. On that, what will be the interest? Current year, what is the contribution in excess of 7,50,000? On that, what is the interest on an average basis? Plus the same thing which has happened in the last years, on which what is the interest. Now coming back to the explanation. Okay, TP is taxable perquisite. Please write it once. TP is taxable perquisite. PC is employer's contribution to approved funds. Employer's contribution to approved funds in excess of 7,50,000. Okay, in excess of 7,50,000. Remember, I am not even including any of the unapproved, everything approved funds only. In excess of 7,50,000. Okay. PC1 is employer's contribution. PC1 is employer's contribution to approved funds in the preceding years after 1st April 2020. In the preceding years after 1st April 2020. After 1st April 2020. Friends, there is a difference between previous year and preceding year. Previous year is the year for which you are computing the income. Any year before that is known as preceding year. Where did we understand this in law? In the beginning of the law, we will understand this in section 6, residential status. 60 days or more in the previous year, in the second basic condition, plus 365 days or more in the 4 years preceding. Okay, preceding means before the previous year, and I have written like that in your notebook, but in the circular they have said that this is actually directly from the circular. Aggregate of in excess of 750 to the RPF and approved for the previous year or years commencing on or after first 20 other than current previous year. So you need not confuse it so much. You can understand previous year for us all. 21, 22 is our previous year. Any year before that is preceding years. Fortunately, we are very closer to the provision. So only 2021 will come for us. Only 20, because this is an amendment of 20. That's why I have been telling employees' contribution also, probably before your examination, they are going to release a formula like this on how to compute. In that case, I will cover it in the revision session. Okay. TP1. TP1. Okay. Aggregate of taxable perquisite of the preceding year. Aggregate of the taxable perquisite of the preceding year. Okay. Again, you have started the answer with TP, taxable perquisite. This is for the current year. TP1 is for 2021 for all of us now. Okay, we can understand. How to find out the rate? Rate is equal to I divided by favoring FAVG. How to find out the rate? Rate. Okay. What is I and what is favoring? I, aggregate amount of income, aggregate amount of income from the contributions. Whatever is the interest, my dear friends, whatever is the interest of the current year, that is known as I. Okay, interest of the current year. FAVG is favoring is opening balance in the fund account, or you can even write aggregate opening balance because all funds put together, aggregate opening balance plus aggregate closing balance divided by 2. Aggregate opening balance plus aggregate closing balance divided by 2. Okay, patiently read it. Patiently read it. Okay, to quickly repeat, perquisite value is equal to, okay, the contribution in excess of 7,50,000, okay, divided by 2 into rate of interest. Rate of interest, I am finding out rate of interest. Total interest divided by total contributions on an average basis, because contribution is spread across April to March. Plus last year, what was my, now it is last year, preceding years, what was my contribution in excess of 7,50,000? Preceding years, what is the excess interest? Okay, on that also I would have paid interest. Okay, interest is payable on accumulated balance. Accumulated balance will include interest also. So on the compounding basis, I just find it out. Let us understand it by working out a couple of questions. First question is for the employee's contribution. Rudra, an employee of Kailash Limited, basic salary and DA forming part 5 lakh per month. Her employer contributes 12% of the said sum to recognized provident fund, 10% to pension fund, and 2% of to superannuation fund. He explained the individual treatment and collective treatment of this contribution. Trying to recollect something also, that's why I have written it so. This is for the first one, that the employer's contribution should not exceed 7,50,000. Have treatment as a lengthier column for you. Have treatment as a lengthier column in your notebook. Particulars, amount, and have treatment as a little lengthier column so that you can write it how this is. Okay. Basic salary plus DA 5 lakhs into 12. 5 lakhs into 12, 60 lakhs. Basic salary plus DA 5 lakhs into 12, 60 lakhs. Employer contribution to RPF 12% of salary. So this into 12%, this is exempt. Okay, up to 12% contribution becomes individually exempt. I'll come to aggregate later. Okay, in excess of 12% only it is taxable. So this is exempt. This is exempt in the treatment, write it as exempt. Superannuation fund, okay, at 2%. 60 lakhs into 2%. 1,20,000. Superannuation fund, 60 lakhs into 2%, 1,20,000. Write down in the treatment column. Write down in the treatment column, exempt up to 1,50,000. So this is also exempt individually. This is exempt. Okay. Now the threshold is 1,50,000, my dear friends. Previously, it was a lesser quantum. Now the threshold is up to 1,50,000. What I have contributed is only 1,20,000. Pension fund at 10%. Pension fund at 10%. 60 lakhs into 10%. 60 lakhs into 10%. I want the class to understand if this is not an amendment, but how to treat it because of two purposes. First, I will tell you the treatment. This will be taxable as salary and then deduction under section 80 CCD subsection 2. This will not fall within that 1,50,000 bracket. This is away from 1,50,000. Apart from 150 plus this also I can claim. One reason I want you to understand is the treatment. This will be first included in employee's gross salary. Later, I will provide up to 10%. Here it is 10%. Why I am making this as a point is, while computing 115 BAC, this can still be claimed. Normally, 115 BAC, if you remember, for optional tax regime for individual, Chapter 6A deductions cannot be claimed except 80 CCD subsection 2 and of course 80 JJAA. Okay, so for these two purposes, I want you to write the treatment. Okay, so that somewhere we will store it in our mind. Okay, in the treatment, please write it down. This is taxable. This is taxable as gross salary in the hands of employee. This is taxable as gross salary in the hands of employee. Full stop. However, deduction under section 80 CCD subsection 2. However, deduction under section 80 CCD subsection 2 will be provided. Full stop, continue. Just to ensure we have a comprehensive answer, this deduction is available even if assessee opts for 115 BAC, optional tax regime. This deduction is available even if assessee opts for 115 BAC. When it comes to aggregate, I am going to tax 6,90,000. Okay. So individually, these might be exempt. 720 is exempt. 120 is exempt. 6 lakh I add and deduct again. Okay. Individually, these are not taxable. But collectively, the aggregate employers contribution comes to 14,40,000. Aggregate employers contribution comes to 14,40,000. Remember, 7,50,000 is only exempt. Balance 6,90,000 becomes taxable. 7,50,000 is only exempt. Balance 6,90,000 becomes taxable. Any doubts, my dear friends? I hope it's clear. I don't see anything. So why I took this time is to make you understand and recollect how to treat pension fund. Okay. Pension fund and provident fund are not treated in alike manner. Provident fund here itself more than 12%. It is as if adding what you have contributed, reducing 12%. Whereas here, I go in a different treatment. First, I add whatever you have contributed, later reducing up to 10%. Instead, they can all, the other way of putting it is pension fund of the employer's contribution to pension fund in excess of 10% becomes taxable. Because you add the entire thing and reduce up to 10%. So it means the same for provident fund and pension fund. Now I'm going to question number 3. This is from our material, study material question only. X is appointed as a CFO of ABC Limited in Mumbai from 1st May 2020. His basic salary 5,50,000 per month. He is paid 10% DA. He contributes 11% of his pay and DA towards RPF, and the company also contributes the same amount. The accumulated balance in the recognized provident fund for the year opening closing. Compute perquisite value chargeable in the hands of X under section 17 subsection 2 clause 7 excess contribution by employer, and 17 subsection 2 clause 7a excess interest credit. Okay, 17 subsection 2 clause 7 excess of 7,50,000 which is contributed by employer. 17 subsection 2 clause 7a is the formula which we are working out. Okay, the question is not about taxable salary, it is only about the excess contribution, excess interest. His basic salary 5,50,000. So first we work out this basic salary 5,50,000. DA, okay, he's paid 10% as DA. DA forming part 10% of basic pay, which is 5,50,000 into 10%. These are monthly salary is 6,05,000. Annual salary becomes 6,05,000 into 12, 72 lakh 60,000. 72 lakh 60,000 annual salary. Can I help you? Employers contribution to PF. Employers contribution to PF 11%, 11% of annual pay, that is basic pay plus DA. Okay, 7 lakh 98,600. 7 lakh 98,600 less maximum non-taxable contribution 7 lakh 50,000. Taxable perquisite under section 17 subsection 2 clause 7 excess contribution. If you don't remember the section numbers, absolutely not an issue. Okay, do not worry about it. 48,600. Am I clear to you? Okay, right. Now I am going for excess interest credited. The second part of my discussion is excess interest credited by fund. The second part of my discussion is excess interest credited by fund. for this purpose, I need to understand what is the interest credited by fund for the current year. Interest for financial year 21-22. Interest for financial year 21-22. Opening balance in fund account. Opening balance in fund account 15 lakh 35,000. Opening
Sir,
balance in fund account 15 lakh 35,000. Employees contribution, we know both of them are contributing the same amount. Employers contribution, closing balance without considering interest. Closing balance without considering interest should have been 31 lakh 32,200. Actual closing balance 33 lakh 55,000. Therefore, interest. Therefore, interest of the current year is nothing but 2 lakh 22,800. Therefore, interest of current year 2 lakh 22,800. I am repeating how I did it. I took the opening balance. Okay. The interest they have not given straight away in the question. Okay. I need to find out what is the interest credited. My opening balance plus contribution minus closing balance gives me the interest that I have earned during the year. Shall we move on? Okay. Now, what is PC? What is PC in our explanation? What is PC in our explanation? Okay. Contribution. Okay. If you look at what is PC, it is aggregate contribution in excess of 7 lakh 50,000. Aggregate contribution in excess of 7 lakh 50,000. Aggregate contribution in excess of 7 lakh 50,000, which is nothing but 48,600, which is nothing but 48,600. Okay, which we have already taxing 48,600. What is PC1? That is for the year commencing from 1st April 2020. Okay, what is the aggregate contribution in excess of 7 lakh 50,000? Since we are very close to that year, it becomes easier for us. Otherwise, if after this question, after 2-3 years, they will give this quantum. Okay, aggregate contribution in excess of 7 lakh 50,000 in FY 2021. Okay, this employee has joined employment. This employee has joined employment. Okay, on 1st May to the question says on 1st May April to, I hope I have not lost connection. Friends in online, if your connection goes off due to some technical reason, please keep me informed. Please keep me informed. I'll answer this questions first. Sir, in question number 3, is it only for 11 months? We have calculated. No, it is for 2021 only 11 months. 21-22 is full 12 months. We have done only for 21-22. Okay, we are doing only for 21-22. It is for 12 months. Okay. And the next question, sir, is he employed from 1521? No, my dear friends, the question is 1520 only. It is not 1521. Okay, right. Coming back. In the financial year 2021 is there. Here only employed for 11 months. Here only employed for 11 months. So we all have know what is this basic pay plus DA per month, 6,05,000. Okay, so 6,05,000 into 11 months into his contribution. His contribution is 11%. Okay, 6,05,000 into 11%. So in the last year, he has not contributed. Employer has not contributed in excess of 750. So this becomes zero. This becomes zero. Repeating why the question, because you all got little confused why the question is using 1520. This is, we are closer to that amendment here. Okay, if it has been 2-3 years, then they will give the quantum. Now they want you to find out. They want you to find out. So they have given you what is his last year's salary, because after 1st April 20, in that year, if they has contributed, the employer has not contributed in excess of 7,50,000. The employer has only contributed 732. When PC1 is 0, TP1 will also be 0. Obvious, because TP1 is computed on PC1 of the last year. So TP1, okay, last year or preceding year perquisite will also be 0. Preceding year perquisite will also be 0. Okay. R will be interest divided by opening balance in fund plus closing balance in fund divided by 2. Okay, R will be opening balance plus closing balance divided by 2. Okay, so we all know what is the interest component. 2,22,800 divided by what is the opening balance in the fund account? 15,35,000. 15,35,000 plus 33,55,000 divided by 2. Divided by 2. This will give me R. What is that amount? What is that percentage? Yeah, 9.11%. That's what our friend says. It comes to 9.11 as a percentage, or I can even do it and show you. 2 lakh. If I give you the link later when you are referring to the Excel, you will find it out better. Okay, if I have it as 2 digits, it comes to 9.11%. Okay, so PP is equal to taxable perquisite value of the current year is equal to 48,600 48,600 into 9.11 percentage plus everything is zero. Okay, PC1, TP1 and all is zero. So I am getting a perquisite value of 449. This time. 48, sorry, 48,600 by 2. Sorry. By 2, yeah. I have only found out. Yeah, average balance 2214. 2214. 2214. As a MCQ, they can ask if they want to this question. Okay, right? A quicker calculation is needed. Okay, but they can ask, they will not be asking as a main question, I believe. Okay, since we are closer to this. Okay, but here the first question gets important because this is current year amendment. This is question number 1 is current year amendment, my dear friends. In question number 1, I did this 40,278 directly. இதுக்கும் இந்த மாதிரி ஒரு formula, the same like formula they are going to give. Let us wait for the circular. Otherwise, this is how it needs to be computed. A same circular, a same formula computation will be provided. Until that time, this is the circular. So these are all the amendments. Yeah. Okay, friends. Sure. If I am fast, yeah, always you can stop me. I'll wait. So okay. So I'm progressing, my dear friends. But if you want me to wait, you can text me. I will wait. So this is how this interest is. This is there. This question I have picked only from. This is not my own question. This question I have picked only from our study material and worked out. Shall I move on? So, salary, this is the only amendment, plus the two important concepts of last year's amendments, because the circular came at the end of the fag end of the year, we have worked out and seen probability of questions or more. Now, house property does not have any amendment. House property chapter does not have any amendment. That leads us to the PGBP, which has one major amendment which changes the dynamics. Well, for students who have been in the classroom of 1920 or 2021, there are cases like Smith Securities. Okay, a perennial argument took place between the department and the assessees, on one particular aspect. Is goodwill eligible for depreciation? What is intangible asset? The term intangible asset includes know-how, patent, copyright, trademark, license, franchise, or any other business commercial rights of similar nature. There was a full stop. Now, whatever I have written in blue is the current year. There was a full stop. So, assessors started claiming goodwill as a depreciation for goodwill. Goodwill is nothing but the difference between the purchase price and the net asset taken over. Self-acquired goodwill will not be considered at all. The revaluation money. Revaluation is never a concept under income tax law. So assessor was claiming goodwill. Remember, there is a very valid argument from the income tax department saying that know-how, patent, copyright, trademark, these came into usage only in the 20th century. The 1900 க்கு மேல தான், okay, these type of words like trademark, copyright, but right from the day accounting started, goodwill was there. If somebody asks you, what is the explanation of intangible, you will start with goodwill. So when goodwill is a term which is there for a longer period of time, but the law specifically has not started with the term goodwill or not even used the term goodwill. Know-how, patent, copyright, trademark, license. So many things they are not saying. Will they not say goodwill, which is there in term for very long? So the assessing officer started contending you cannot claim depreciation on goodwill because goodwill is not a specified asset. Then they went into court. Various courts took the stand. Any other business or commercial right, ejusdem generis. Okay, any other thing of similar nature, you call it as goodwill, let it be any name, you get a right, so depreciation can be claimed. That is not the intention of the law. So to cap that case law and to close this argument, in Finance Act 21, there is a straight word, not being goodwill of business or profession. In the profession is certain tanepo. Okay, so that also solves one big doubt people had. For many interpretation it's solved. I'll come to that. So not being goodwill, Finance Act, that is the budget, is presented to the parliament on 1st Feb. So 1st Feb 21, our finance minister presented the budget for the last year, and she said that it is not even available for 2021. The year is not yet over. This is a retrospective amendment. This is not a prospective amendment. This is not from the financial year 21-22. It is from the financial year 2021. But as a student, I want to tell you that this is not yet being questioned. So you are going to be questioned on 2021 on this. Okay, I know 21-22 is the opening balance lay vara mudiyadhu. If they ask you opening balance of goodwill 5 lakhs, you will say, you will laugh at it and say question is wrong. Solladinga, okay. Our institute is capable of that. But I am generally saying that the question can now be for 2021 in this case. The amendment is with a retrospective effect from 1st April 2020. It is not there in Finance Act as said that it is 20. They have not used the word retrospective amendment because The government promised there will not be any retrospective amendment. So they did not use that word. Hence, depreciation cannot be claimed from the financial year 2021. The impact of this amendment is, okay, even for purchased goodwill, you cannot claim. And if you purchase a goodwill from the financial year 2021, value to be recorded is 0. Okay, it becomes a non-depreciable asset. I'll come to the argument of some people later. Okay, now, where are all it is going to have an impact? Okay, let us try to understand the two circumstances which this particular rule 8AC read with 43. What is 43? We all know 43 talks about determining the actual cost of the asset. Repeating, 43 talks about determining actual cost of the asset. Sir, can you give me an example? Yes. Suppose a building which is used for non-business purpose is brought into the business. Suppose a building which is used for non-business purpose is brought into the business, we compute the value as had it been used for the purpose of business from the date of its purchase. What would have been its current value? We arrive at the value. Similarly, 43 is the section which says amalgamation, demerger, holding subsidiary transactions. In all these cases, value to be recorded in the transferee's book is the value that was prevailing in the books of the transferor. So 43 is a very dynamic section. If we, in our regular classes, we used to say 43 is a support section. 43 is the whole 28 to 30, 28 to 40, okay, has various things. Suppose 43 CA, it tells us about building or immovable property held as stock in trade. Actual consideration will be sale value or actual whichever, I mean stamp value or actual whichever. So 43 is a support section. So 43 now has been redesigned. Circumstance 1, where, okay, sorry, where goodwill is the only asset in the block. I'm sorry for using typing punch there. Okay, where goodwill is the only asset in the block. Okay, where goodwill is the only asset in the block. அது மாத்திரம் தான் இருக்கு intangible blockல. Nothing, no problem. Do not claim any depreciation from 1st April 20. Do not claim any depreciation from 1st April 20. And if the block ceases to exist, I will not charge any capital gain. When goodwill is the only asset, how does the block ceases to exist and capital gains will come? I will prove you. Last year, I would have had some assets. I would have sold some assets. அதனால goodwill value would have got reduced. We all know about the block of asset system, because of which the goodwill value. I will prove you about the second point when I do some questions. But please understand, if goodwill is the only asset, it is not depreciation. If goodwill is the only asset in the block of intangible, no problem, don't claim depreciation. I will not claim capital. I will not, okay. Obviously, capital loss da varum, adnal da avanga bisolranga. Okay, that's why. Okay, yes. Where goodwill is one of the asset in the block. Where goodwill is one of the asset in the block of intangibles. It is not the only asset. I have trademark, I have know-how, I have patent, something. Okay, so the depreciation format I am trying to recollect for you. Opening WDV, additions divided into 2, 180 days or more, less than 180 days, less sale consideration, money received for asset discarded or demolished during the year, less value of goodwill as on 1/4/20. Value of goodwill as on 1/4/20 should be reduced. How will I arrive at value? Look at the date on which goodwill has been purchased. Till today, what would have been the depreciation had that been the only asset in the block? So that you will arrive at the value. Okay. So many of our, many times I used to tell our friends that you all think that for income tax purposes, individual asset value need not be maintained. No, it needs to be maintained. It is useful at the time of slum sales. It is useful now if you have maintained it. Okay. Whatever value you have arrived at, you reduce. Suppose if this result in ceasing of the block, then the capital gain will come. Then the short-term capital gain will come. Okay, write in our notebooks, please. In our notebooks, please. Treatment of goodwill in a shorter way. Treatment of goodwill. Treatment of goodwill. 1. Okay. From the financial year 2021, depreciation cannot be provided. Self-acquired. Self-acquired is never an asset. Okay. From the financial year 2021, depreciation cannot be provided. From the financial year 2021, depreciation cannot be provided. Point number 2. Point number 2. In case of profession, value realized for goodwill will be value realized for self-acquired goodwill. That is also an amendment, remember. In case of profession, value acquired for self-acquired goodwill will be treated as capital gains. Previously, there was a big number in our study material. If I am right in capital gains chapter, Amol, a chartered accountant, there will be a question. That question has been nullified now, because there they will say for profession the goodwill will not be self-generated goodwill. Now the Finance Act has neutralized in terms of business or profession. CAOA, they have said whatever value you are realizing will be treated as capital gain. Now in your notebook, okay, heading depreciation and capital gains have two falling branches. In your notebook, in the center of the line, depreciation and capital gains. Depreciation and capital gains have two falling branches from there. Depreciation from there, two falling branches. On the left hand side, if goodwill is the only asset in the block, if goodwill is the only asset in the block, if goodwill is the only asset in the block, under that, no depreciation, no capital gains. No depreciation if goodwill is the only asset in the block. No depreciation, no capital gains. On the right hand side, if goodwill is one of the asset in the block, if goodwill is one of the asset in the block, if goodwill is one of the asset in the block. Okay, it is not the only asset, it is one of the asset. Under that, A, eliminate the value of goodwill, eliminate or reduce the value of goodwill from the block by arriving at the value, assuming it is the only asset in the block. It is the only asset in the block. As if it is the only asset in the block, arrive at the value and eliminate it, my dear friends. Okay. Next, if the elimination result in cessation of the block, or if the elimination result in block ceasing to exist, if the elimination result in block ceasing to exist, the result is capital gain. The result is capital gain. The result is capital gain. Are you clear? Okay. If the elimination result in block going out of existence, the result is capital gain. Remember, if the block is still there, if the balance is still there, it is, you will compute the depreciation, okay, for that. And later the depreciated goodwill is sold. What happens, okay, in the after the diagram under that, what happens if later that goodwill is sold? What happens if later goodwill is sold? What happens if later goodwill is sold? What happens if later goodwill is sold? Under that, cost of acquisition will be WDV as on 1420. Cost of acquisition will be WDV as on one, the one which you eliminated, no, from the block. You eliminated some value, no, that becomes the cost of acquisition. Okay. Now there is a big issue now. Is the gain long-term gain or short-term gain? Can indexation, you have said depreciable asset, you will not have indexation. It is no more a depreciable asset. Clarity is not there, but one advantage we have is for our year, it can only be short term. Okay, for our year, for our examination. So don't worry about it. As of now, the clarity is not there. Okay, please remember the treatment of goodwill again, either as a part of the question or as a standalone question. The chances of being tested are more. The chances of being tested are more. So where goodwill is the only asset, do not claim depreciation, no capital gains also. Where it is one of the asset, the opening WDV as on 1420, which is nothing but the closing WDV as on 31/3/20, needs to be computed and reduced from the block. How will I compute? Assume that as the only asset from the date of its purchase and start computing. After reduction of goodwill, whatever balance we arrive in the block shall be considered as balance available for that compute depreciation. Where due to reduction, the block goes out of existence, then it will result in short-term capital gain. Question number 1. A block of intangible assets as on 1st April 20. Patent, copyright, purchased goodwill. This is the block value. This is not the purchase value. Okay. Asset purchased during the year 21-22 or goodwill, trademark. Compute depreciation for the financial year 2021 and 21-22. Part B of the question. If the old goodwill other than the one which is purchased in 21-22 is sold for 7,50,000, what will be the tax treatment? 17 lakhs plus 8 lakh 40 plus 6 lakh 50. 17 lakhs plus 8 lakh 40,000 plus 6 lakh 50,000. Remember, first I will take it as a opening balance. Okay. The block of intangible as on 1st April 20. So these are opening balance. Additions. For this year, there is no additions. For this year, there is no additions. That is for 2021, no additions. Deletions. Value of goodwill as on 1/4/20, which comes to 6,50,000. Balance available for depreciation. Balance available for depreciation 25 lakh 40,000. Balance available for depreciation today. Less depreciation for FY 2021 at 25%. Closing WDV as on 1/4/20, 31/3. Always depreciation is the answer. Where I have purchased goodwill after 1/4/20, where I have purchased goodwill after 1/4/20, I cannot record any value to that. The value will be nil. Okay, I cannot record any value for that. Trademark purchased, put to use for less than 180 days. 14 lakhs. There are no deletions, so directly balance available for depreciation plus depreciation for FY 21-22. 14 lakhs into 12.5% plus 19.05 lakhs into 25%. One நிமிஷம் 14 lakhs into 12.5% plus 19 lakh 5,000 into 25%. Thank you. So this is the mode of computation. Okay. Now there's a second part of the question which says, what if this goodwill is sold? Okay. Part B. Okay. Computation of capital gains by applying provision of section 55, which tells us the cost of acquisition. Okay. Full value of consideration. Full value of consideration is 7,50,000 less COA, cost of acquisition. Okay. Value as on 1/4/20. Value as on 1/4/20, which is 6,50,000, which is 6,50,000. Okay. Short term capital gain. Short term capital gain is 1 lakh. Short term capital gain is 1 lakh. Well, I believe this is a depreciable asset till particular point of time. So I have worked it out like this. We have to await the clarification for whether it will be treated as henceforth along like land, a non-depreciable asset, etc. But this year you will not be having a problem. This year we will not be having a problem. Let us see. Our institute material has not clarified that part. So we will wait for that. If goodwill, the question here is, if the goodwill is sold, will depreciation calculation change? No. Value of goodwill as on 1/4/20 to be removed, will be removed. If goodwill is sold in 2021, that's a you will remove it and separately calculate capital gain. You will not have any. Question number 2. Opening WDV of intangible block is 40 lakhs, which includes goodwill which is purchased in December 18 for 25 lakh. Specify the treatment. Case A, depreciation that is allowable for 2021 and 21-22. Case B, if patent, which is also forming part of the block, is sold for 15 lakhs in March 21. Yes, I am working out 2021 only because I believe the question can be asked like that only. If patent, which is also forming part of the block, is sold for 30 lakhs, if the goodwill is sold for 20 lakhs. First, I need to find out as a working note the value of goodwill that will be there as on 1420. Okay, whoever is asking doubt, can you please text me? I just saw a doubt, so I'll try to take it up and answer. But please text me the doubt. There won't be any change in depreciation charged in financial year 2021 regarding what? Change irkadu. In financial year 2021, there will not be any change because you are not making the adjustment. You are not making the adjustment in financial year. I'm sorry. Yeah. There won't be any change in depreciation. I don't know why you are saying there won't be any change. There will be change. There will be change, Aranganaiki. There will be change in 2021. Probably by working out this question, I can make it more clear to you. Okay. December 18, I had purchased the goodwill for 25 lakhs. Let us arrive at the 1420 value. That is the first part of the answer. Purchase value as on December 2018. Purchase value as on December 2018, 25 lakhs. Less depreciation for 1819 at 12.5%. Okay, less than 180 days usage. So this is opening WDV as on 1/4/2019. Yes, depreciation for 1920 at 25%. Value of goodwill or written down value on 31/3/20, or you can even write it as 1/4/20. 16 lakh 40,625. This is the value of goodwill as on 1/4/20. 16 lakh 40,625. I am working out part A now. I am working out part A of the question. The part A is compute depreciation for the like last question, for the financial year 2021 and 21. Opening WDV of the block, opening WDV of the block 40 lakhs. Additions. This is as on 1420. This is as on 1420. Additions, okay, nothing is there. Deletions, okay. WDV of goodwill as on 1420. Okay, 16 lakh 40,000 625. WDV of goodwill as on 1420. 16 lakh 40,000 625. Balance available for depreciation less depreciation for 2021 at 25%. Closing WDV slash opening WDV of next year. Next year also, there is no transactions like addition or deletion. Okay, less depreciation for 21-22. These are all the answers as depreciation for 2021 and 21-22. Am I clear to you? Okay. Okay, friends. Right. Now I am going to part B of the question, which tells us what will the question itself is, what if I have sold patent? Goodwill is not the only asset in the block. Okay, the question asks us, okay, if patent, which is also forming part of the block, is sold for 15 lakhs, is sold for 15 lakhs, okay, and the next is 30 lakhs, okay. Sale value of patents 15 lakhs. Sale value, revised value of goodwill deletion will be two things. Sale value of patents pertaining to the block, okay, 1 lakh 61,133 for the current year. Last year 214,844. The most important is this. What if the sale value of patent is 30 lakhs and that of goodwill we reduce 1640? Whatever I get is known as short-term capital gain. Whatever I get is known as short-term capital gain. Remember, where goodwill is one of the asset in the block, where goodwill is one of the other, where due to reduction of goodwill, the block goes out of existence, then the result is short-term capital gain. Always when the block ceases to exist, okay, 6 lakh 40,625 is short-term capital gain. So, where it ceases to exist because of goodwill, short-term capital gain. Okay, 640. Part D of the question. What happens if the goodwill is subsequently sold? Okay, full value of consideration, that is, it is sold for 20 lakhs. Cost of acquisition, which is nothing but WDV as on 1/4/20, again short term capital gain. This cost of acquisition is due to operation of section 55. This cost of acquisition is due to operation of section 55. Are you clear? Are you understanding completely? Yes. The question is, when we reduce from the block, but the asset is still there? Yes. Sir, in part C, what is the logic of treating it as capital gain, sir? Why can't it be treated as business loss or income? First answer for your question is section 50 says for depreciable asset. For depreciable asset, it will only be capital gains and not business income. It is not a business income. Section 28 doesn't talk about it. Section 50, capital gains chapter only speaks about it. Second, your question is, what is the logic of this short-term capital gain? The logic is very simple. My opening WDV X5 exclude this is 23 lakh 59,000 and I have sold it for 30 lakhs. Please don't understand the logic in the reverse manner, saying that, oh, because of goodwill capital gain came. No, because of sale only capital gain came. Because of goodwill capital gain did not come. Okay, because of goodwill I am just removing whatever is the cost. This 40 lakhs consists of this 16 lakh 4625. That is what I am removing. Because of removing goodwill, capital gain did not come. Because of this, after removing goodwill, I have a value where I have sold it for over and above that value. So I am getting a capital gain. And this is the treatment as per section 50. It will not be a business income or loss. You don't do business with asset. You only do business with stock. So assets will go to capital gains chapter. That is the logic. Part C is always, yeah, exactly. Part C is what we are doing always here. Thank you. Question number 3. The opening WDV of intangible 40 lakhs, only goodwill is there in that block. Explain that track statement. If in the above case, the said goodwill was purchased in 1819 for 70, and in that year there was a sale of intangible due to which only the block value becomes 40. What will be the treatment? So the opening WDV, probably in 2018-19 I had many intangible assets and there was a block, a group. Slowly I sold off my patent. Slowly I sold off my trademark. Now my intangible consists of only one asset, that is goodwill. What will happen to the treatment? Okay, this is the case this is the first tree which you wrote on the left hand side. Okay, which says where goodwill is the only asset in the block, do not claim depreciation for 20 and 2021 21 22, where the block ceases to exist. There is no capital gains now. There is no, okay, like how I was answering our friend now. Capital gains is not because you exclude goodwill from the block. Capital gains can only be because you get a sale consideration. In our income tax law, we have seen capital gains chapter to a larger extent fair enough to the assessee. Whenever you get money, only you are paying tax. Insurance compensation, taxable in the year in which compensation is received. Asset converted into stock in trade, taxable only in the year stock is sold. So now goodwill I exclude பண்றதால, because I am excluding goodwill, if I will not get any capital gain. Because I am selling an asset only, I will get capital gain. Okay, so coming back to the third question. everything is logical is due to the passion I have on the law. I know there are places where doesn't work also. உன்னே நாளைக்கு என்கிட்ட கேட்காதீங்க. In the part A, if goodwill is the only asset, that 40 lakhs goes off, block becomes zero. Block becomes zero. Subsequently, when you sell, you can take this over and above 40 lakhs or short-term capital gain or loss. Okay. Part B. Okay. Part B. Look at how we are working. Now, computation of value of goodwill as on 1/4/20. As a first step, let us work out value of goodwill as on 1/4/20. Okay, as on 1/4/20. Goodwill was purchased in 1819 for 17 lakhs. Purchase value in 1819, 70 lakhs, less depreciation for 1819, assuming 25% more than 180 days, less depreciation for 1920 at 25%. So I'm just like that doing here, minus 1750 into 25%. Okay. Closing WDV as on 1/4/20. Closing WDV as on 1/4/20. Is this clear? Okay, I'm sorry. Closing WDV as on 31/3/20. Now look at my computation. Opening WDV as on 1/4/20. Opening WDV as on 1/4/20 is 40 lakhs less, okay, value of goodwill as on 1/4/20 is 39,37,500. The block ceases to exist. The block ceases because that is the only asset in the block, and the block ceases to exist. Will it result in capital gain or loss? The answer is no. Where goodwill is the only asset in the block, which is the case, okay, just because in the past the goodwill was acquired at a different value, etc. Now if you get a different value, the block ceases to exist, so no capital gains. Okay, block cease to exist, but neither capital gain nor capital loss will be computed. Just like that, the block value will become 0 and there is neither a capital gain nor a capital loss. Maybe part of a question, maybe as a standalone question, but it will be, please remember, you need to work out for 2021 also. Angada working 21-22, there's no working, it's a direct computation. If at all they have said that any goodwill is purchased, the value to be recorded is nil. So the whole the point gets clarified or clarity only in that year. So this is about goodwill that came into as an amendment. Then apart from this is a major amendment. It has a spillover effect on capital gains also. Okay, this is a major amendment. Apart from it, one of the best clarificatory amendment is to make that Kicha Sugar's case nullified and to give a clarity for employees' contribution. 43B is not applicable. For employees' contribution, 43B is not applicable. Okay. For employees' contribution, my dear friends, 43B is not applicable. It is due date as per the relevant act. For suppose Provident Fund, 15th of the subsequent month. Deduction is allowed if the contribution is made before the due date as per the respective statutes. Okay, and the wording of the law is very important. Not only they clarified it prospectively, they clarified it retrospectively itself. For removal of doubt, it is clarified that the provision of 43B shall not apply and shall be never deemed to have been applied for the purpose of determining the due date. So it is not the due date. Employer contribution only due date. Okay. Employee contribution. Quickly in our notebook. Employees contribution to provident to statutory funds. Employees contribution to statutory funds. Employees contribution to statutory funds. Under that, to be deposited on or before the due date of respective statutes. To be deposited on or before the due date of respective statutes. Of the respective statutes. Okay. To be, okay, the due dates of respective statutes. Next point. Next point. Okay. Where it is not deposited, can you complete? ரொம்ப கொடுமையான ஆன்சர், நான் ஒத்துக்க மாட்டேன். Should be treated. Okay, please understand, where it is not deposited within the due date, disallowed illa, it should be treated as income. It should be treated as income. It should be treated as income. it should be treated as income where it is not deposited within. And can you tell me the next point? At least people who have seen my... Okay, straight opposite is the answer. Charodu தூக்கி போட்டுறவன. Okay, next point. Subsequent payment assessee will not get the deduction. Employer contribution to employee contribution. There is a big difference between employer contribution. If I can retrieve the file, 1 minute, I will show you. Not sure whether I can retrieve it. System is very slow. I'm sorry. In 43B, this is the chart, thankfully. This is the chart I want you to understand. Treatment of contribution of both employee and employer. Employer, when it is due on 31st March, the same has to be paid before the due date of filing returns. Where it is not paid within the due date, then it will be disallowed in the year of incurrence. It will be allowed in the year in which actual payment is made. Inga, employees contribution, I never say when it is due in March. Every month. If you are properly filling your 3CD, you will understand this. Okay? The highlighting word is properly. Okay? Right? So, every month, this has to be paid within due date of every month, not on 31st. In this provision is only for 31st March. Where it is not paid within due date, it will be treated as income. Subsequent payment will not be allowed as deduction. Will not be allowed as deduction. Okay? This is a clarity now by the Finance Act itself. Am I clear to you? So subsequent payment will not be treated as income. This is one clarificatory but very important amendment. Again, one of the adjustment in the question is going to be this. 43CA amendment, I will take it along with 50C or 56, whichever it is. I will take that amendment, there. Other than that, 44AB, amendment in, please write down, amendment in section 44AB. Amendment in section 44AB. There are actually two amendments. One is a clarification, another is an amendment. I was telling last year itself, because inside the law they use the word, if the cash receipt exceeds 5%, if the cash payment exceeds 5%. People thought only cash. No. Wherever they are using the term cash, it includes three things: cash, bearer check, cross the check. It includes cash, bearer check, cross the check. Please understand, it includes all the three. Okay, that is the clarification given by, that is a clarification. This year that 5 crores becomes 10 crores. Okay, so in that amendment, point number 1, the term cash means, cash, bearer check and cross the check. Cash, bearer check and cross the check. The term cash means cash, bearer check and cross the check. Second, the second amendment or the second point is, okay, where cash payment, so you know what is cash, where cash payment does not exceed 5% of total payment, where cash payment does not exceed 5% of total payment, slash cash receipt does not exceed 5% of total receipt. Cash receipt does not exceed 5% of total receipt. Cash payment does not exceed 5% of total payment. Cash receipt does not exceed 5% of total receipt. The threshold for tax audit is 10 crores, is increased to 10 crores. The threshold for tax audit is 10 crores. Okay, okay, well, okay. Remember, which we already know, when I say receipt and payment, I mean both capital and revenue. All types of receipt, all types of payments. Okay, right. In case of profession, if it exceeds 50 lakhs and other things, you are aware. Okay, this is the amendment part of it. Other things, otherwise it is only 1 crore. And 44 ADA as a clarificatory amendment, but not LLP. Because firm includes LLP till last year applicable for all associates except companies. So people thought even LLPs can claim because the law is silent. LLPs always the books has to be maintained. There is no option of not maintaining books. So 44 ADA is not applicable for LLPs also, and it is only for resident individual, HUF and partnership firms, not excluding LLPs. Am I clear to you? So these are all the amendments in PGBP chapter as a standalone chapter. Goodwill along with section 50. Okay, the last two amendments alone. Let's do a question to wind up PGBP. Then take a small break to start capital gains. Question number 4. Net profit of the company after allowing the following is 43 lakhs. Compute the profit after the undermentioned adjustments. 1. Employees' contribution to Provident Fund included, which I purposefully typed, but in exam they will not tell you. It is obviously it is included in salary. Okay, when I pass the entry, I will pass it as, for example, as a journal entry, salary account debit 5 lakhs, to bank, to PF, to TDS, to bank. Okay, so you can understand salary, it's always inclusive of it. Coming back, employees' contribution to Provident Fund for the month of April, May, June 21, remitted in August 21. It should be treated as income because every month this has to be seen, not year end. every month. Employer's contribution for the same period remitted on the same date, no problem, allowed in the financial year 21-22 itself. Employees' contribution for the month of March 22, 10 lakhs, 50% remitted on April 10th. So that is no problem. Balance 50% will be treated as income. Employer's contribution remitted in September, absolutely not an issue. Depreciation on goodwill as per book, the said goodwill was purchased, it will be disallowed. You cannot claim. So quickly, question number 4. Yeah, 15 lakhs. The taxable business income comes to 66 lakhs, my dear friends. the taxable business income comes to 66 lakhs due to the adjustments. Can you close the door? The taxable business income comes to 66 lakhs. You cannot claim even if there is a subsequent payment. Am I clear? Look for one adjustment in one of the questions. It can be assessment of companies, firms. Somewhere there will be an adjustment because now that the law has come clearly and told that you cannot claim it. Till last year, we did the same thing, but we wrote a note. However, in Kicha Sugars Limited, in some other case laws, 43B is applicable for employees' contribution also. We wrote a note like that. Now that is not necessary. The total receipts and payments of an individual carrying on business is provided. Specify whether the individual is bound to get his books audited. Sale of goods, 5 crores. So, if the total cash receipt and cash payment 5%, within 5%, you need not. Remember, it is total. Sale of goods, sale of assets, scrap sales, interest, miscellaneous receipt. Payment, purchase of goods, other expenses, purchase of assets, income tax paid, investments made. Try it out, try it out, quickly try it out. Quickly try it out. I want you to try it out. So I'm getting, in terms of receipt, the sales total, and when I say unapproved, I mean cash, bearer check, cross the check. So for me, the total comes to 33 out of 755. So it is only 4.37%. It is only 4.37%. Sales, the cash sales is 20, asset sale 8, scrap sales 5, so 33. The total is 755. The total is 755, so 4.37. On the other hand, out of the total payment, 27 constitutes cash payment. 27 constitutes cash payment out of 555. That comes to 4.86. In case of payment or receipt, the percentage of transaction does not exceed 5. Hence, the threshold limit is 10 crores. The actual turnover is only 5 crores. Remember, the actual turnover is only 5 crore. Assessee is not liable to get his book accounted due to turnover criteria. Probably less than 8%. Again, you will come back to the same. Yeah, first point adana கொடுத்திருப்பாங்க. The sales. Sales is the turnover. So that will be taken as the basis. Okay. Yeah. So next is capital gains. Almost all amendments are in capital gains, be it slum sales or 45 for dissolution or reconstitution of a firm, and very many small amendments in capital gains chapter, both in resident and international taxation. Okay, if you leave capital gains and see, then it will be trust 147 like that. So capital gains constitute the major part of our amendment. Okay, let's go slow on this whole aspect of capital gain. First is unit linked insurance plan is now a capital asset. Is now a capital asset. What is that I am trying to? What is a capital asset? Capital asset means property of any kind held by the assessee, but does not include stock in trade, rural agricultural land, personal movable personal assets other than jewelry, art, architecture, painting, gold bonds, special bearer bonds. These are not capital assets. Other than that, everything is a capital asset. This definition has also said high net worth individuals who are paying insurance are falling under this. Is this new to us? First, let me take a minute and explain to you. No, this is not new to us. We already have a linking of section 1010D. We already have a linking of section 1010D, 80C and 194DA TDS provision. என்ன linking? Life insurance premium in 80C is allowed only up to 10% of policy value for policy taken on or after 1/4/2012. Before that, 20% of policy value. They are only small assessees. If you are paying more than 10%, that means your maturity period will be less than 10 years or 10 years, closer to 10 years. If you are paying more than 20 years, you know the maturity. So they are high net worth people. So the proceeds becomes taxable. 1010D exemption is not available for them. The proceeds becomes taxable. And 194 says, if the proceeds are taxable, then tax has to be deducted at source on the bonus component, difference between premium paid and maturity value. This is the overall constitution of that provision. Now I have brought ULIP also into that. Amendment to definition of capital asset. Any unit linked insurance plan to which exemption under 1010D does not apply due to the 4th and 5th provision. What is that 4th and 5th provision? For people who are investing more than 2,50,000 in a year. For people who are investing more than 2,50,000 in a year, I am going to tax them in ULIP if they are investing more than 2,50,000. How the investment can be in one policy or in more than one policy. That's 4th provision, 5th provision. 4th provision, ULIP issued on or after 1/4/21. What is this on or after 1/4/21? Why? Sorry, 1/2/21. Because date of reading the budget. If the finance minister has told this will be applicable from 1/4/21, February and March, Unit Trust of India would have become the richest body. People would have gone and deposited all their money there because the returns are much better and it is linked with insurance. Okay, so the date of reading the budget and the date of amendment are the same. ULIP issued on or after 1/2/21. If the premium payable for any of the previous year during the term of policy exceeds 2,50,000, single policy. Fifth provision, aggregate amount of premium exceeding 2,50,000 of any of those policies of a person for more than one ULIP. Okay, so both are same, 250. Fourth provision says one policy, fifth provision aggregate of all policies. Now it is a capital asset. So maturity is taxable. That's what the law says. At the time of maturity, whatever you get over and above what you have paid will become taxable. Anna? Maturity would not have happened before 31/3/22. So the law has not said the quantum. What is the quantum? Okay, I'll explain you. So now this is a capital asset. If you are paying ULIP more than 2,50,000, it is a capital asset. Okay. However, taxability does not arise if the amount is received due to the death of the person, the legal heir receiving. How is this taxable? As I told you, it is too early to say how this is taxable. Notwithstanding anything contained in 45(1), which talks about the exemptions, where any person receives at any time during previous year any amount under ULIP, then any capital gain shall be deemed to be the income of such person in which the amount was received, and the income will be taxable in the prescribed manner. The law has not yet prescribed because we are just 1 year old from the date of amendment. Okay. So this is applicable under if 1010D exemption is not applicable. Okay, if 1010D exemption is not applicable, then capital gains. When 1010D exemption will not applicable, fourth and fifth provision, it will not be applicable. In that case, we will tax it under capital gains. We have to wait for the prescribed rules, but as of now, amendment. So amendment in capital gain. Amendment in capital gain. One, section 2 subsection 14 definition has been amended. Section 2 subsection 14 definition has been amended. That is, definition of capital asset has been to include ULIP, which falls under fourth and fifth provision of 10 subsection 10D, which falls under fourth and fifth provision of section 10 subsection 10D, which falls under fourth and fifth provision of section 10 subsection 10D. Okay, please understand this amendment is applicable for assessees who are covered under fourth and fifth provision. For fourth and fifth provision, exemption is not applicable. Okay, 1010D. Also, in your material, I have written the direct language. Any ULP to which exemption does not apply. So that is the fourth and fifth provision. Okay. Next point. Fourth provision specifies premium on a single policy not to exceed 2,50,000. Fourth provision specifies premium on a single policy not to exceed 2,50,000. Fifth provision specifies aggregate premium not to exceed 2,50,000 for all policies put together. Ten ten D. The provision says, fourth provision, it will fall under 1010D if it does not exceed. 1010D தான் நம்ம படிக்கிறோம். 1010D is an exemption. It will not, the exemption will apply if it does not fall. If it does not exceed 250 or aggregate. We have to, okay, right, right. I will reframe. Fourth provision specifies that exemption will be applicable if the premium for a single policy does not exceed 2,50,000. Fifth provision specifies exemption will be applicable if the aggregate premium for all policies of a person, if the aggregate premium for all policies does not exceed 2,50,000. Next paragraph. Where exemption is not applicable, you know when exemption is applicable now. Where exemption is not applicable, then capital gains will be computed in the prescribed manner. We stop there because we are yet to see what is the prescribed manner. Indexation unda kadayada. Let's all wait. Question number 1. Comment on the tax treatment of the following. Everything related to 1010D. Painichami took a life insurance policy in 2015 for a sum assured of 10 lakh, paid annual premium of 1,25,000. So it exceeds 10%. What happens is the maturity proceeds becomes taxable. The total premium paid 10 lakhs and the policy is expected to mature in March 22, 12 lakhs. Charanya Yashwant took ULIP in 2020, sum assured 30 lakhs and paid 3 lakhs. Dinesh took 3 ULIPs in March 21 for 1 lakh each. However, the total premium does not exceed. So, I'm comprehensively trying to make you understand 1010 because ULIP is not just a unit policy of mutual fund. It also has an insurance component. Okay, so the provisions are applicable like that. Let's go slow. Okay. The premium paid exceeds 10% of policy value. The premium paid exceeds 10% of value. Hence, maturity becomes taxable. Hence, maturity becomes taxable. Insurance company is liable to deduct tax at the rate of 5% on the income component. Maturity value minus premium paid. Okay, okay, tax to be okay. This is next is okay. Okay, you a sum assured 30 lakhs and paid a premium of 3 lakhs. Okay, so the premium, okay, exceeds 2,50,000, but still it is not taxable because the policy is taken in 2020. This provision is applicable only for policies taken on or after 1/2/21. Okay, right? So, policy is taken before 1/4/21. Premium not exceeding 10% of sum assured. Hence, maturity proceeds are not taxable. 1/2. 1/2. Okay. Policy taken after 1/2/21. Okay. premium exceeds 2,50,000 per annum, even though it is less than 10%, this ULIP will become a capital asset at the time of maturity. It will become taxable at the time of maturity. It will become taxable as per prescribed method. So as per the method is yet to be prescribed, the mode of computation is yet to be prescribed. Once prescribed, it will become taxable. Yeah. Um, we'll wait for the rules. His question is, what if there are three policies, 1 lakh each, so 3 lakhs? What if after a couple of years, 1 lakh for one of the policy closes and it continues now as 2 lakhs? I just told him, let's wait for the prescribed rules. As of now, we are only closer to the amendment, so it will be straightforward. Okay, so this is an amendment in ULIP, okay, which got importance because ULIP has become now a taxable aspect. Okay, now I am going into some valuation rules. Can you tap it? Can you tap that? Before going into slum sales, let me talk about the importance of valuation rules because of the FMV1, FMV2. Also, this will give you an idea about two other provisions. Section 50CA, which is sale of unlisted shares. Sale of unlisted shares, full value of consideration will be actual consideration or fair market value of the shares on the date of sales, whichever is higher. 50C Mari. Stamp duty Mari 50CA. Also various other provisions, but more importantly I am going to deal with because it is going to talk about slum sales. More importantly, it is about slum sales. Am I clear to you? Okay, how to value certain things. Section Rule 11 UA specifies the valuation basis. Rule 11 UA specifies the valuation basis. Accordingly, every asset is being valued. Okay. I don't think I can find it right now. But anyhow, I just thought I can show you Rule 11 UA. Okay. But how this is being valued? All capital assets, all capital assets are going to be valued in this rule. We all know what is a capital asset. Jewelry, fair market value on the date of valuation. On the date of valuation by me on the date of slum sales or on the date of gift or on the date of, okay. If it is an old asset, you need to obtain a registered valuer's report saying what is the fair market value. Work of art, architecture, painting, same manner. Quoted shares, transaction value, quoted shares, transaction value, okay, or the lowest value. If the transaction is not through recognized stock exchange, lowest value in the recognized stock exchange, remember it is only the lowest value which should be taken on the valuation date. Unquoted shares, I'll come to that. Okay. Unquoted securities and other than equity shares, fair market value. Okay. How to value unquoted shares? This is also mentioned. Okay. Step 1, the investee company, company in which investment is made, find out the net worth. How will you find the net worth? In the same basis I just told you with small differences. Second, your share value will be, investor's share value will be net worth divided by total number of shares in that company into shares held by me proportionately. So how do you, immovable property, always stamp value. Listed shares, fair market value on the date of transfer or immediate. If one unlisted share company invest in another unlisted company, which is unquoted shares, again value it in the same manner. Jewelry, FMV, any other assets, book value. Okay, that is for debtors, everything. What is not considered as asset, advance tax, TDS, TCS, less refund due, deferred expenditures, less liabilities. Okay, a quick look through in your notebook, please. This I know is not an amendment, but this is essential to go to slum sales. Quick writing in the notebook, please. Valuation rules as per 11 UA. Valuation rules as per 11 UA. Nature of asset, basis of valuation. This is the 11 UA that is been determining the market values. Okay. Okay. Value of jewelry, value of art, architecture, value of shares. Okay. In the case of unquoted equity shares, A plus B. Okay. So I'm just making it simpler so that we don't go into this complicated circular. Okay. We'll make it simpler. Okay. 11 UA valuation. Okay. Immovable property hyphen stamp duty. Immovable property, immovable assets hyphen stamp duty or stamp value, sorry, not stamp duty, stamp value. Immovable property hyphen stamp value. Jewelry, work of art, architecture, painting, jewelry, work of art, architecture, painting, hyphen fair market value. Fair market value. Okay. Remember, if it is more than 50,000, you'll get a registered valuer's certificate. Quoted shares. Fair market value on the date of transaction. FMB on the date of transaction, or the immediate preceding date of transaction. Lowest value on the immediate preceding date of transaction. Can you tap that? Unquoted, unquoted, unquoted securities other than equity shares, F&B. Unquoted securities other than equity, fair market value. Quoted equity shares, quoted equity shares, proportionate net worth. Quoted equity shares hyphen proportionate net worth. Proportionate net worth means, as I told you, same valuation principle divided by total number of shares into shares held. Unquoted equity shares, unquoted equity shares, proportionate net worth. Any other asset, book value. Any other asset, book value. Are you clear? So, this is essential to go and find out for slum sales. Okay, this is essential not only for slum sales, for many things, but for slum sales it becomes all the more essential. Now, before going into slum sales, let me answer a question for you. The balance sheet of X Limited, equity shares, capital reserve, securities premium, general reserve, revaluation reserve, loan, general loan, current liabilities, bank OD, land, plant and machinery, building, jewelry, artwork, listed shares, debtors, stock, advance tax. Other information. Stamp value of land 40 lakhs. Value of jewelry as per registered valuer 20 lakhs. Value of artwork 8 lakhs. Fair market value of listed shares 20 lakhs. Mr. Sridhar, who owns 40,000 shares. Okay. Total number of shares is 140 lakhs divided by 100 should be 1,40,000 shares. Okay. Mr. Sridhar, who owns 40,000 shares, intends to gift 20,000 shares to Srikanth and sell the balance 20,000 shares for rupees 150. Analyze. Read through. Starting from asset side, land, stamp duty value, stamp value, how much is that? 40 lakhs. 40 lakhs. Plant and machinery, book value 1 crore 11 lakhs. Book value 1 crore 11 lakhs. Building, book value, since stamp value is not given and it's a depreciable asset, 25 lakhs. Jewelry, registered valuer value, how much is that? 20 lakhs. Artwork, remember, if the registered valuer gives a lesser value also, we should take that one. We have not said book value or registered FMV, whichever is higher. It is registered valuer. Okay. Listed shares. Debtors 8 lakhs, stock 2 lakhs. Only external liabilities. In that also, I will not take any contingent items. In that also, I will not take any contingent item, income tax liability and all. In that also, I will not. Okay, only external liabilities, no reserves, no dividend, nothing. Okay, so if I look at it, loan 40 lakhs, general loan 3 lakhs, current liabilities, bank OD 10 lakhs. Net worth. Net worth 1 crore 73 lakhs. Net worth 1 crore 73 lakhs. Are you getting it? Okay. Number of equity shares. So what happens is, I'm finding it per share, 140 lakhs divided by 100. Okay. Value per equity share. Value per equity share 124. Value per equity share 124. Is this clear? Okay. Per equity share, the value is 124. Now, the question says, my dear friends, the question says, Mr. Sridhar, who owns 40,000 shares, gift 20,000 shares to Srikanth. Okay. For Srikanth, provision of section 56. Okay. 56 to 10 or 211, don't worry about it. Section 56 is more than sufficient for you. Okay, is applicable. Value of gift received. Okay, 20,000 into 124. Okay, since it exceeds 50,000, the whole of the value becomes taxable in his hands. Okay, in the case of movable asset, okay, if the value exceeds 50,000, the whole of the amount becomes taxable in his hands. This is section 56. Am I clear to you? Okay, now comes, okay, section 50CA, sale of unquoted shares or unlisted shares. Full value of consideration will be actual consideration or fair market or uh, value of share as per rules, whichever is higher. In this case, no problem. He has sold for 150. He has sold for 150. In this case, 150. Had he sold only for 110, I would have taken only 124 and not 110. In this case, he has sold for 150. Had he sold for, okay, or value as per whichever is higher, in the given case, rupees 124 is the FMV, whereas sale value is rupees 150. Hence, rupees 150 will be applicable. So, I'm trying to make you understand that this entire provision of valuation is not only for slum sales, though I'm going to majorly apply for slum sales. But before that, I want you to understand it is not only for slum sales. It is more applicable for section 56 gift of jewelry. What is the value of the gift? In the date of the gift, அதுதான் 11UA. It says value on that particular date, on the valuation date, on the date of gift. Similarly, the most important happens to be unquoted shares. How to arrive at the value? Okay, idhila one exception we all know is that discounted cash flow is also an acceptable method, especially for startups, etc. They go by the discounted cash flow method. That also they take it. That also they will be considering. But generally, whenever slow. Now, if I talk about slum sales, you will be, because in slum sales, the asset, the seller might have some unquoted shares. The seller might get some unquoted shares also. The whole slum sales purview changes because of how to compute the full value of consideration. So for that, the valuation rules are very important. valuation rules now becomes important, because that's why I started with valuation rules, though it is not an amendment. But you should understand how this valuation rule, especially for this unquoted shares or unlisted shares, how this valuation rules happens, so that when you go forward, you will be able to understand slum sales with a larger eye or larger perspective. Am I clear to you? Okay, so valuation rules. This valuation rules, once you understand, it is everywhere ditto. 11 UAE, the big control C, control V the majority of the time. Okay, it is only once you have to understand what is this valuation rules, how these things are valued, and everywhere you will find them. But if you look at the material, no, it will lend for 10 pages, because everywhere they would have repeated the valuation rule. Valuation rule is simple, straightforward. This is the valuation rule. In the valuation rules, if you remember exit tax in trust 115T, okay, there also it will be applicable, because when a trust goes out of existence or it has been amalgamated with a non 12AB, okay, at that time there also valuation rules plays a role. The term valuation rule is a constant rule across all chapters. So that's why I took this time to make you clear about the valuation rules, so that when you go to slum sales, you will be able to understand and appreciate it better. Okay, right? We'll go to slum sales tomorrow morning, 6 o'clock. Tomorrow, we are covering both slum sales and partnership. Okay, the two most important things. Tomorrow, we are covering both slum sales and dissolution of firm. Meet you 6 o'clock tomorrow morning to continue with amendments. All the best, friends.